The stock market is a game of gains and losses. Smart investors know it's not just about buying low and selling high. It's also about locking in profits along the way. This is called profit taking. It helps you secure your wins before the market takes a turn. Think of it like this. You buy a stock at $50, it goes up to $60, then drops back down to $45. Ouch! But if you had a profit-taking plan, you could have sold at $55 or $58 and made money. Profit-taking brings discipline to your trading. By setting profit targets, you take emotions out of the equation. This is crucial when the market is volatile. Greed and fear can lead to bad decisions. Remember, a smaller, consistent gain is better than a big loss. Taking profits also frees up your money. You can then reinvest it in other opportunities. The market is always changing, with new chances to make money. By taking profits, you stay flexible. You can diversify your portfolio or invest in a different sector. You might even reinvest in the same stock if you think it will go higher. Profit-taking is like taking your chips off the table in a winning poker hand. It ensures you don't walk away empty-handed, even if the game takes a turn for the worse. One popular profit-taking method is the 20 to 25% rule. This is especially useful for growth stocks. This rule is simple. When a stock goes up 20 to 25% from your buy price, sell it. Why? Because many stocks, especially those with strong growth, tend to pull back after such a rally. Let's say you buy a stock at $100. It climbs to $120 to $125. The 20 to 25% rule suggests it's time to sell and lock in your gains. This helps you avoid the risk of the stock dropping back down. Remember, this is just a guideline. The best profit-taking point can change. It depends on the stock, market conditions, and your risk tolerance. This strategy works best when you choose your stocks carefully. Look for companies with strong fundamentals, good earnings growth, and a history of price increases. A stop-loss order can also limit potential losses. This order automatically sells your stock if it drops to a certain price. Why is the 20 to 25% range so special for profit-taking? Research shows that many strong growth stocks tend to rise by this much after breaking out from a chart pattern. After this initial surge, they often consolidate or pull back. This happens as early investors take profits and new investors assess the situation. By selling within this 20 to 25% zone, you're capturing the initial upward momentum. You're also reducing the risk of losing those gains during the pullback. It's about being smart, not greedy. Of course, some stocks will keep going up beyond 20 to 25%. It's tempting to hold on for more, but stick to your plan. Don't let emotions control your decisions. There will always be other opportunities in the market. The key is to manage risk and make consistent profits, not chasing the absolute highest price. Section 4. Putting it into action. Applying the 20%-25% strategy. In real trading, you won't always buy at the perfect entry point. Let's imagine a stock you like has a potential breakout point at $50, but it jumps to $52 before you can buy. Here's the key. Your profit-taking targets should still be based on that $50 entry point. So you'd aim to sell between $60 and $62.50, which is 20 to 25% above $50. This keeps you consistent. You're capturing that predetermined profit, no matter your exact entry point. Of course, if you're very confident in the stock, you have options. You could sell a portion at the 20 to 25% target and hold the rest. Use a trailing stop-loss order to protect your profits on those remaining shares. Remember, discipline is key. Set your targets and stick to them. Section 5. Tailor-made trading. Adapting the strategy to your style. The 20 to 25% rule is a great starting point, but the best strategy is one you can stick with. It should fit your risk tolerance, goals, and trading style. Are you comfortable with more risk for potentially higher rewards? You might consider a wider profit-taking range, like 30 to 35%. Do you prefer a more cautious approach? A tighter range, like 15 to 20%, might be better. The key is to find what works for you and stick to it. Keep learning, keep refining your strategy, and remember to take those profits. Remember, consistent profits are the name of the game in the stock market.